Fast fact: Wall Street in Lower Manhattan is named after the location of a real wooden wall built by the Dutch colonists in 1653 to protect themselves from the British and Native Americans. I'm Drew Thomas, and you're listening to Bank Chats. Welcome to another episode of AmeriServ Presents Bank Chats. I am Drew Thomas, your host, and we're going to talk investments today. Investing is something that I think is somewhat misunderstood, or maybe there's just not even misunderstood. Maybe there's just a lack of understanding as to how investments work. And so with us today is Frank Lapinsky. He's the president and CEO of Westchester Capital Advisors, and we're going to be talking with him and discussing all sorts of things investment related. So hi, Frank. How are you?
Good, Drew. Thanks for having me.
Absolutely. Thank you for being here. We definitely appreciate it because I don't know the answers to these questions and you do.
I hope I do.
Yeah. So tell us a little bit about yourself and your background, where you're from, how you got to where you are.
Sure. I came up through the ranks of investing, been managing money for over 37 years now.
Okay.
Started a long time ago, been through many market cycles. I manage about $500 million overall, close to 500 clients, and so I've been around. I've seen a lot of different market cycles, economic issues going on, and it's something we deal with every day. So investing is 24/7, 365. It never shuts down after we go home after 4:30.
Yeah. So when you say market cycles, you're talking like the stock market, that sort of thing. Okay.
Yeah, I've been through many recessions, many inflationary type periods that we're even in now. A lot of market cycles that contain wars, unfortunately, or economic issues that come about. So yeah, many of them I've seen. So I've been around.
So basically, whenever the nightly news shows us the Dow and the NASDAQ and things like that, you actually know what the numbers mean.
Correct.
That's what you're saying.
Correct.
Okay.
Those are the three that most people do pay attention to. And we focus most of our attention on the S&P 500 of those three. You usually get the Dow, the NASDAQ, and the S&P 500. And so we focus on the S&P 500 index.
Okay. And you mentioned inflation in there too. So I want to kind of talk about that a little bit too. But before we get into that, all the little details, what does an investment advisor or investment company do?
What we do is we take monies from our clients, and my accounts range from anywhere from $5,000 up to $69 to $70 million per account. Whenever I talk to a client, whether you have $100 or you have $10 million, it's all important. So what we try and do is when a client wants to invest monies for the future, whether it be for a personal trust account or a 401k, we sit down and we talk strategy with the client. We see where their risk tolerance is. So basically, somebody they've garnished some wealth and they know they can't potentially manage it on their own because nowadays markets are moving much faster than whenever I started 30 some years ago. So you really have to be nimble. And so when a client sits in front of us, we sit down and we get to know them very well. And through those conversations, then we make a strategy of investing the monies for the future.
Okay. So you said something like 401k. So really a lot of people might be affected by this just through their retirement, through their employer or some other fashion as far as that goes, right?
Correct. When I started back in the early 80s, where I was at my first job, we didn't have a 401k. Now that's the limelight of investing is a 401k for someone who's working. And everyone who has a job, I'd say 9 out of 10 employers have a 401k. And it's so important that all the investors have to realize that if an employer matches the money that you put in, let's say up to 3%, at all efforts, you should be putting in the 3% because you're making 100% on your monies before it even gets invested.
Okay.
So that's very important for all 401k participants to realize, and then not only that, but past the match every year, the way you can make your life simple, but yet you could garnish a lot of monies at the end of your working career is add 1% to your 401k each and every year. So let's say you start out 3%.
Okay.
The next year, you put 1% more in, that's 4%. And you keep going the whole way up as far as you can. The goal is to at least get to 10% for an individual.
Mhm.
So if you have a spouse and your spouse is 10, if you could get to 10%, that's 20. I believe personally that's enough investing because we all have bills. We all want to live a life. We don't want to put all of our money for the end of the end of our working career.
I'm eating ramen now, but I can eat steak later.
There you go.
Yeah.
So, but it's important, and most people don't realize that. Again, now reiterate this: whether you have 5,000 or 70 million, every dollar you have of your own is so important. You want to make it work for you and grow.
So really, that's what you're doing. You're giving your money to work for you because, generally speaking, and again, I'm going to say this probably a couple of times throughout this, and we always have a disclaimer, but like when you're talking investments, there's no guarantee of a return, but there are averages that you work with and you can look at over time, right? So theoretically or practically, you are getting generally some sort of a return over enough time that you're investing your money and you're going to get back more than what you put in.
And that is correct. And you have to stay the course because if you watch the news is mostly giving you bad news on the air. It might scare you, especially in the investment world. Mm-hmm. In the investment world, you have what is called bulls and bears. A bull is somebody who's very positive on the stock market, let's say, and a bear is one who's the opposite, the negative. So to make TV interesting, they usually pit both the bull and the bear against each other during a day. And it sort of confuses you. And that's why news is more entertaining, if you will, even in the investment arena. It's always very important you have a good investment advisor to guide you through these times.
Yeah, I agree with you there. I mean, no matter what the news is, the bad news sells. I mean, I hate to say it that way, but bad news sells. If it didn't, then every nightly news would be talking about the local skateboarding dog and not about some horrible cataclysmic event that has happened that day, right? So I get what you're coming from there. Now, you said, this obviously can affect you as an individual, like through your 401k or what have you. You said 401k is the most common. Are there other retirement vehicles out there that people might be aware of? Yes.
Well, there's what is called IRAs. And the best IRA to be in is called a Roth IRA. And also, a lot of 401k plans have a Roth 401k. And what a Roth is that you pay the tax before you invest the money. So if you're investing $100 a pay into, let's say, a Roth 401k, you pay the tax up front. And then when that money grows, and if it doubles, triples, quadruples, there is no tax whenever you take that money out versus the way most traditional IRAs and most traditional 401ks act is it's pre-tax. So if you double, triple your money in an IRA or a 401k by the time you retire, every dollar you take out is taxable. That's why it is better to pay the small amount of tax on your investments each and every pay. And then when you garnish that huge amount of money throughout 10, 15, 20, 30 years, everything that comes out, Uncle Sam does not touch because you paid it up front. That's the greatest investment vehicle, in my opinion, to be in anything that has the word Roth in it.
Okay. So you said, 20, 10, 20, 30. So essentially there's that old adage that like there are two best times to start investing, right? 20 years ago and today, right?
That's correct. That's correct.
So can you ask your employer whether they offer a Roth 401k or a standard, or do you have a choice?
Yes, you do. Most employers are offering a choice of either the standard or the Roth. And it really, and I will say this, most people, when they invest their money in a 401k, it's very confusing. It's sort of like death. Nobody wants to talk about it until the very end. And then sometimes that's too late. I tell all investors, whether you're a 401k investor or a personal investor, if you look at your statements at least once a year and know what's in it. If not, again, if the markets go up 20%, but your account only went up 10% because you didn't have good investments, it's very hard to get that 10% back when the markets went up so much. But yes, you should talk to your employer, talk to the vendor who has the 401k, and just see, again, it takes very few minutes that you could do to try and find out this information, and it will really help in the long run. But again, I will tell you, Drew, most people, unfortunately, do not pay attention enough to their investments.
Yeah. And you said about having like a trusted advisor. I mean, I've seen the papers that come out that have all of the different investments that are as part of your portfolio, right, in your 401k. And I can tell you right now that there are a lot of them that I wouldn't know A from B from C. So I agree that having somebody that you trust, that you can work with and talk to, matters a lot, because unless you make this your life's work, you're not likely to know every little investment that's in there, right? I mean,
that's correct. It's very, unless you're a novice and you may be one out of 100 people that really looks at it every day and every night. But most people don't want to deal with it because, as you said, it's very confusing. You don't know the investments. That's why even here at our company at Westchester, we offer our phone numbers 24/7, 365 to all of our personal clients. And when we do educations to the 401k plans, they also get access to us 24/7. How many people honestly have done that over the last 20 plus years? I'd say about a dozen. So again, and what people don't realize is 30, 40 years ago when 401ks weren't very popular, people weren't putting a lot of money away. Well, a lot of younger folks that are starting in the 20s and 30s, they're going to have hundreds and millions of dollars. And it really means a lot to have good advice.
Yeah. So when we talk about that good advice and the people with experience, I want to touch a little bit about some of these companies that are out there now where you can do your own investing, right? They have these companies where you can, and companies like Robinhood and things like that. Like, is it a good idea to invest a lot on your own like that? Or do you really feel like you really probably should have a past history or education in this before you start investing?
I would say yes, but I'll also add one other concept to that, or one other idea, that before you start investing on your own, you should be maximizing your 401k or your IRA for your retirement. And once you feel that you've put enough money away and you want to, I'll call it gamble with your money by going to a Robinhood thinking you're going to throw a dart at a dartboard, or you hear something really hot on TV you want to invest in, do that with excess cash that you may have. It's sort of like use the cash that you may go to a casino with.
Yeah.
And you're willing to lose it. But before you do any of that, you should be funding your 401k or your IRAs. And then, again, there's nothing wrong with doing that, but you don't want to take all your retirement money and go to a casino.
Yeah. And that's kind of, I think you're right. I think it's a good analogy. There is a certain amount of gambling associated with that, because if you don't know the company and you're talking to somebody on the street or a buddy or something that says, hey, I got a hot stock tip for you, you don't really know whether that's a good investment or not, right? So that's why a professional advisor really is where you'd want to go.
Yeah, and that's true, because even if the company is good off a hot stock tip, what happens if we break out into a bigger war than we're in right now with Russia, Ukraine, or over in Israel? Again, the company may be sound, but it's the market that will bring that company down. So if you put too much money into one individual investment like that, it could be a very good company. It's not very advisable because you don't know what could happen when you wake up the next day.
Yeah. So that brings me up to something that you mentioned earlier and that I wanted to circle back to. Like you said about the news, and then you're looking at the numbers and so forth. But a lot of this stuff is affected by world events.
Correct.
Right. So, and even if you may or may not be, if you're a self-employed person, maybe you don't have a 401k, maybe you have an IRA or something along those lines, or maybe you're just relatively young and you haven't started investing in anything yet. This still affects you, right? Because those world events affect the monetary system and things like inflation, right?
Correct. Yeah, it's very complicated. It's something, again, that when you invest, you got to look for the long term. We are always going to have wars, which have been around since the beginning of time. We're always going to have issues internationally, which have been there for quite a while. Even the weather could, we get a hurricane somewhere that could affect insurance companies. It could affect building companies. So yeah, there's a lot of extraneous type of issues that you have to look at, not just at looking at an investment that you're in. And it's well advised to stay diversified as much as you can with your investments.
Okay, so let's touch on that number. Let's touch on that word, right? Because you hear that all the time, diversified. So let's define that and maybe break that down a little bit. What does that mean to be diversified?
Diversified could take on several meanings. Number one, it's always advised that if you're going to invest for your 401k, we use our 401k.
Okay.
You don't want to pick just one mutual fund and put all your money into that fund, because there again, it may work for a while, but with market cycles, you may be in a fund that could get hit really hard if inflation's around or if oil prices skyrocket. All depends on what type of fund that you're invested in. It's advised that you look at anywhere from 5 to 10 different mutual funds for diversification. That's what diversification is. Spread your money out. You don't want to, you don't want to go to the casino and put all your, and I'll use this as an analogy. If you had $100 and you went to casino, most people wouldn't put that $100 in at one spin. They would try and break it up amongst many spins to try and have the odds in their favor to win. Well, this is what you do with the 401k. You don't want to put all your money into one investment, one mutual fund. You want to diversify it. Now, there are investments out there that have several mutual funds underneath it, like an umbrella, and that's good. A lot of them called life cycle investing, target date investing. So there are investments. But most people, because they don't understand, will like throw their arms up and say, I'm just going to put it all in this one fund. Well, there again, if the market's up 20%, but that fund's only up 10, you've left 10% on the table, and that's not a good thing to do. So that's one way of diversifying, is to make sure you have multiple investments. The other way of diversifying too is that you don't put all your money into 5 technology funds or 5 financial funds.
Okay.
Even though that may be the hot topic on TV today will be the financials and technology, especially with AI coming about. You want to make sure that the funds that you're diversified, you stay even more diversified by looking at small cap, international, large cap. Just again, spreading your money out to be a little safer, if you will.
So you would have something theoretical, and again, we're using these as examples. We're not saying that this is what you should or shouldn't do.
Correct.
But you might have something in the medical field, and then something in the technology field, and then something in the services field, or something along those lines.
That's right. That's correct. Because again, something that's very hot today could be very cold when you wake up the next day and find out that you're down 20 or 30% in your investment.
So we had talked a little bit about the concept of, investing over time. And you had said something could be, big today, down tomorrow, or at the same time, if you're putting all your eggs in one basket, like your mom and grandma told you never to do. Right.
Correct.
And you say, well, this is down, the market's up 20, but this is down to, at what point, and again, maybe this is where an advisor comes in, where you've had experience. At what point has enough time passed that you can make a determination that, yes, this is not likely to perform as well as, say, something else?
The way you could look at that is you should always pick an advisor that you pay a fee to for performance. And the word is performance. So if you have an advisor, and that advisor should be gauging his or her selections of your investments against indexes like what we see on TV at night, the Dow, the S&P, or the NASDAQ. Because once again, anybody could throw you, me, we could all go, let's call Fidelity up and buy some funds. But if you don't monitor those funds, you don't keep an eye on those funds, then if the market does go up 20, you may be down 10. And you can't get that back once again very easily. So if you find an advisor and pay that person what they call an annual fee, not a commission, and you keep their feet to the fire where they have to show you how well they've performed, then it's up to them to show you performance. And we do that at Westchester. That's how we operate. We're not on commission. We're on an annual fee. Even our 401k, all of our selections, we show performance every quarter. So I think that's very important. And unfortunately, Drew, most money managers cannot outperform the markets year in and year out. So the newest concept is, if I can't beat the indexes, I'm going to come up with something different. And they call it goal-based investing. So what they're saying is, if you have $50,000, let's say, in retirement funds, and you want to grow it to $200,000, well, then that's our goal. It may take 20 years, but versus if you say, okay, you have 50,000 and I'm going to judge you on your performance, then that'll get you to that goal, your goal, much quicker. So goal-based investing is really just looking at the market value's growth over time. So again, you could be up 10%, not 20, but the advisor kind of slides underneath the carpet with that goal base. And I've grown up just the opposite way, where it's all performance-based. How well are we doing for our clients? And how well are the 401k participants doing? We pay a lot of attention to that.
Yeah, that makes sense to me, because again, you would think there's a commercial on TV, when our clients do better, we do better, right? It's the same idea, right?
Correct. That's the same concept. Yes.
Yeah. So this isn't Wolf of Wall Street where you're being
No,
you're
no.
right. Yeah. So let's touch a little bit too on the concept of inflation, because I think a lot of people misunderstand or have a bad understanding of why inflation is what it is and how it's calculated and how that affects the markets and so forth. Because you hear you hear stuff in the news. Well, the Fed's going to raise or lower interest rates based on inflation and stuff. So can you talk a little bit about what inflation is really?
Sure. Inflation is basically what you pay for a product in the store. And I'm going to use that at that level. So if you went to buy a gallon of milk, and let's say it was 2 or 3 years ago, that 1 gallon of milk could have cost $4.
Okay.
Today, several years later, that gallon of milk costs five and a quarter. So that increase from a couple of years ago means that the producers of that milk and the stores that sell the milk is costing them more.
Mm-hmm.
And why is it costing more? Well, what happens is inflation comes about a lot of times whenever we have periods in our economy of high unemployment, which means that people aren't looking for jobs. So to produce the product, it's going to take more people, more overtime that are currently working. So when a company has to pay more for their workers overtime than hiring another worker, then that goes to their bottom line. That's going to cost more to produce a product. Or if you have fewer people in general, then what happens is, and we'll use a car manufacturer. During COVID, when everything was shut down, manufacturers were producing cars. So if you wanted to go get a brand new car in a lot, guess what? You're up 20 or 30% because they had fewer cars on the lot. Now, where we're at today, a couple of years after COVID, more and more cars are being produced. So the cost of these cars are coming down. So inflation is too much money chasing too few goods. And that's basically what it is. So yeah, it's a tough concept to sometimes grasp. And when the Fed starts to raise interest rates, again, that could be several reasons that's going on because our inflation is too hot. Mm-hmm. They want to slow things down basically as they raise interest rates. But after COVID changed everything. I mean, it's very difficult in the investment world now to look back at the last recession we had, let's say back in 2008, and say, okay, this is how it's going to turn out. Well, since COVID came about, we're writing history, not reliving history.
Yeah. So you were kind of going back to those market cycles you talked about.
Correct.
Like right now, we're kind of in a cycle that has never really been seen.
Right. And for a lot of economists, and I'll give you an example. Last year on TV, at the beginning of 2023, every economist was calling for a recession, a hard landing. Basically, we're going to crash in the stock market. And it was just the opposite. And one of the things that all the economists said they missed last year at the beginning of the year was the resilience of the consumer. Because with COVID, we had, unfortunately, so many deaths and people were just getting all that money from the government. As the money was running out from a lot of the consumer pockets, they had to go back and get jobs. Well, because there was so many job openings, a lot of places were offering starting wages that were much higher than normal, $14, $16, $18 an hour. So what that did last year, and this is where all the economists missed, as these consumers went out to get these jobs, they were able to still continue to spend, just like what they were spending with the government stimulus money. And so that pushed our economy along quite well. And that's why we had a 20+% return in the stock market. And that's another reason why, when you asked earlier, when's the right time to invest? It is today, or 20 years ago. If you wait for a market crash or you think you're going to wait for the world to come to an end, you're too late. And you really have to be just really religious when you're investing constantly.
Yeah, I think that the biggest takeaway that I've gotten from reading and even in my own personal experience, what I've had like in my retirement savings and things like that is just understanding that there used to be a thing back, I think it was like in the 90s, it was really hot for a while, like day trading and stuff like that. Like this isn't day trading. It's called investments for a reason. You're investing your money. You're investing your time. There is a time cost to this, right? That you have to be willing to accept.
Correct. And the earlier you can start investing, the less you'll have to work as you get older. I'm in my 60s and I'm going to go to normal retirement, but a lot of these younger kids coming out of college now that are going to have these great matchings in their 401k, even though Social Security may not be the same by the time they retire, if they get good advice, good education from an investment advisor or from their employer, they won't have to work half as long as you and I are working now.
So if I wanted to come to you as an investment advisor, well, first, I guess, let me start with this. I have a 401k through my employer. Do I deal directly with my employer on that? Or do you work as an investment advisor with a company to create that 401k? Or do I go directly to you? How does that work?
You go through your employer for the 401k. If they offer a 401k, and sometimes they call it a 403b, if you're in the government arena of investing. But yes, you go through your employer, and then your employer hires somebody like us here at the trust company, hires AmeriServ to manage their 401k plan. And then we go out and we'll educate.
Okay.
And then we have websites that they could go to, the participants. But yes, it all starts with first going through your employer.
Okay. Now, things like an IRA, which you mentioned earlier, I could do that on my own. I
Right.
do that through my employer. How does that
Correct.
work?
You could do that on your own. Once again, we have IRAs that we manage for our customers and our clients here at the trust company, but that's something that the employer will not offer.
Okay. So is there an advantage to one type of retirement vehicle as opposed to another? Like, is there a 401k advantage versus an IRA advantage, or do they have pros and cons both?
They have pros and cons both, but I would suggest that if you have a 401k and there is a matching, and believe me, I use 3%. There's some companies that will match up to 10%. So if you put in 10, they'll put in 10. That's your first goal in life, is to get to that 10% level or whatever match it may be. Then if your employer has a Roth 401k, that usually gives you a good amount of diversification.
Mm-hmm.
And that's probably better before you go to an IRA. Now, if you're a more mature employee for a company and you're maxing out your 401k, then you could start looking at your IRAs. But
Mm-hmm.
until you or your spouse maximize your 401k contribution from what you could put in, I would say that the 401ks are a better option at this point than an IRA.
Yeah, you've mentioned it a couple of times, and I think that it's worth sort of focusing on just for a second, this concept of a match. So really, when you say 10%, just make the numbers nice and easy. I'm making $100,000 a year, right? So 10% of that is what you're saying I should be trying to put toward my 401k.
Correct.
And if your employer offers a match up to, in this case, say 10%, what they're doing is they're putting that same amount in. So really, I'm getting double my investment.
You're making 100% on your money before you even put your monies to work in the stock market or bond market, wherever it may be.
Yeah.
Yes, that's what a match is called. And so again, using your own monies as a percentage coming out of your pay and whatever. And then there's a misconception that I'm only going to put as much in as the employer matches. Well, again, that goes back to my earlier comments that your first goal is to get to that match. Then
Mm-hmm.
after that, every year, if you put 1% more into your 401k when you're younger, you will not have a paycheck shock when that is happening versus
Mm-hmm.
there are a lot of investors, I shouldn't say a lot of investors, a lot of workers out there that wait until they're 50 to start saving in their 401k.
Mm-hmm.
Then all of a sudden they go out and they put a 15% withdrawal out of their account, out of their every 2-week paycheck. Now that's a paycheck shock when you see 15% coming out. So again, the earlier you could start, the better, but definitely get to that match for every employer.
I'm kind of reminded of that. I don't know if you've heard of this, but you probably have, based on your history and what you do. Like there was that grade school thing where someone said to you, would you rather have a penny a day doubled every day for 30 days, or would you rather have $1 million? Right. And everybody says, oh my gosh, I'd rather have the $1 million. But if you actually do the math, that penny a day for the first 2 weeks, you're still only at like $3, right? but by the end, you've gotten quite a bit of money. And I think it's an interesting lesson when it comes to investing, especially things like retirement, is that it's not until you get to that last 2, 3, 4 years where all of a sudden your money is really multiplying, right?
Yes.
But if you didn't start early enough, you'll never reach that multiplication at the end.
And that's why a lot of workers will work past Social Security, because they weren't able to save enough. Mm-hmm. Now, we all have financial issues in our life.
Yeah.
But it's just planning early and trying to save as much as you can, And again, these younger workers, ones that are single, maybe still living at home just out of college, mm-hmm. There's no marriage, there's no house yet, or So if they could put even extra in as a younger person, then when they do end up having more financial responsibilities as the years go on, then they can maybe pare that back a little bit.
In your experience working with clients, how have you and how successful have you been in convincing younger people who think that it's more important to have the money now? Because I think sometimes you tend to think to yourself, like, I don't know, when I was 15 years old, I wasn't going to be 50 for 100 years. I know that makes no sense.
You're invincible,
right? But you're 15, you're not thinking about when you're 50 years old.
Right.
And suddenly 50 is like right on top of you. So how do you convince somebody who's younger to maybe make that sacrifice and just put a little bit of money away? Have you ever had that conversation with someone?
Yes. I mean, we have. I mean, even my son started a job and I begged and pleaded him to put at least 10% in, and he is doing that because once again, he is only 18 years old and he has no responsibilities at this point in time. But you're right. There are a lot of younger workers when they start out, it's paycheck to paycheck. They want a really fancy car, which may cost a lot more. And again, it's good to have possessions like that, but it comes a lot with the company that they're at. If the company offers an education program, like we've seen with a lot of companies, people are realizing this is the key. We are all living longer. Again, the average life, whenever Social Security started back in the 30s, guess what the average lifespan was for an adult?
I really don't know.
65. And guess when you were collecting Social Security? At 65.
Right.
They never thought we were going to live as long as we're living now. And this is what really opens up the eyes of some of the younger investors. Oh, wait, I'm going to live to 85, 90 now. And all of a sudden they start thinking about this. And again, it's through the repetition of educating the participants. And that's what we do very well at the trust company. We get out there, we offer our services to come once a year to a company. And usually the first year or two is like deer in the headlights to a lot of investors. But as we go back year after year, they start to retain what we're talking about, or they start paying attention a little bit more.
Have you ever had a situation where somebody insisted that they wanted their money invested in a particular place or a particular vehicle or a particular company, and you knew it was a bad idea? What do you do in that kind of situation? Do you try to talk them out of it? Are you obligated to do it anyway? How does that work?
Well, we try and talk to them a little bit about diversifying. I had an aunt that she would watch Jim Cramer on TV. And right when she was done watching him in the afternoon, she'd call me up and say, hey, I want to buy this stock because Jim Cramer was suggesting it.
Yeah.
Well, I'd talk her off the ledge. Let's say she wanted to buy 300 shares. I'd talk her down to 100 shares. So again, you could give advice to people, and that's what we're in the business. We give advice. We don't know, honestly, Drew, what's going to happen 5 minutes from now in the stock market. You know as much as I know. Our advice is looking from a long-term investing perspective, as well as keeping your investments diversified. So if somebody wanted to go and buy 50,000 shares of Apple, we'd be trying to talk them down a little bit. But if they wanted to do that, of course, we would do that for them.
Yeah.
But most people aren't like that, quite honestly. That gets back to the Robin Hood investing that you talked about, that a lot of people are on there. And that's more gambling because, again, I've seen in my career some very prominent companies that you thought would never go bankrupt wake up one day and they're bankrupt. So the CEO's a crook, something like that. Something may happen. So it's tough out there. And getting an investment advisor is probably one of the best things you could do at a young age and listening to investment advice. Let's put it that way as well.
I think that I've read you read so many stories and hear so many about sports figures and things like that too, that have, they get a contract with the MLB, NFL, NBA, whatever it is, WNBA, and they have more money than they know really what to do with at that point. They're young. They don't understand and they blow through it. And suddenly you find out that, they're 35 and bankrupt and working for, a taco joint or something like that. I mean, it does happen, and it's really sad. So again, having that person in your corner has to be good. You guys also have on your website that you are a fiduciary. Can we talk a little bit about what a fiduciary is? Because I think that kind of dovetails with some of the things we've talked about already in terms of how you make your investment decisions and things like that, right?
Yes, correct. So a fiduciary, plain and simple, is a fiduciary is supposed to look out for the best interests of their client. And I'll give you an example. If I was on commission, which I am not, I've never been on commission. I may get you into an investment that has a payback to me much greater, even though it may not be the best investment for you, but I'm getting a return on that investment as a commission to myself because I'm trying to pad my pocket more with monies than trying to make you earn more monies through what you're investing. So that's not a good fiduciary.
Mm-hmm.
A fiduciary is one that sets down a strategy, buys the best possible investments for the client based off their risk tolerance, how much they really want to involve with risk. And you're doing the best you can for the client, not taking into account your own gain, your own self gain. That's what a fiduciary is. And you're right. Years and years ago, before we had a lot of regulation that we have now, there were, like any profession, you have great doctors. You may not have doctors that are so reputable. You have great investment advisors. You may have other investment advisors that are really out there just to make as much commission as possible and not looking at the best interest of their clients. Nowadays, that is changing. The SEC, the rules coming about are making investment advisors more tight with how they invest money with their clients. And they're really watching over them a lot more now. So we're a fiduciary. We always work in the best interest of our clients.
And I think that's important when you're looking for an advisor to maybe
Correct.
look for somebody like that is really, again, you do well whenever we do well, sort of a thing. Like, because it is as you pointed out, like 5 minutes from now, you don't know any better than I do necessarily what's going to happen. There are trends, there are ways to look at things over time, but at the end of the day, you don't really know what's gonna, like, nobody really knows what's gonna happen at 4 o'clock today when the bell rings or
Correct.
whatever, right? So, and you said, like, too, it's not even just like it may have been where there were only a few markets that you had to follow. Like, when the New York Stock Exchange closes, there are stock exchanges around the world that are just opening, and so stock is, now I don't know how much that transitions. I don't know if a company like Google, for example, do they trade on the Japanese stock market as well as they do on the New York stock market, or how does something like that?
Yeah, they do. They trade on all the markets like that. And right now, as I mentioned earlier, an investment advisor, good investment advisors, I mentioned, it's 24/7, 365. Because when our markets close, like as you mentioned, other markets are just opening. And so when I come in the next day, like tomorrow, I'll see what the international markets have done. Or again, it could be some tragedy, unfortunately, that happened abroad overnight that we have to deal with. And it's just not the markets. It's the whole world. It's geopolitical. It's everything that we have to look at.
It's the way you're describing it, it kind of reminds me of this sort of like this domino effect or a butterfly effect of sort of things like you don't think about the fact that, well, I've got myself invested in, I don't know, shipbuilding. And then a worker strike at the docks is putting a hold on all the assembly that's going on. So that's going to affect, and then that affects where they would shop and where they would spend money because they're not bringing in the money that they were bringing in before.
Correct.
So just trying to keep all that straight as a novice, as a person doing it yourself has got to be daunting. I mean, because you just can't think of how many different ways one event can possibly, branch out and affect other things.
And that's right. And I believe that there are a lot of people out there, a lot of investors that try and do it on their own. And it's tough. And you will it's like winning the lottery or going to the casino again. You'll hear that one person that hit it big. And however, you don't hear about the other 100 plus people that went out of money or lost money.
Yeah.
So it's very tough to manage your own monies by yourself. And again, there are a lot of good investment advisors, people that could be out there, very reasonable fee. Again, my suggestion is you always pick somebody that doesn't charge any commission, but they charge you an annual fee. And then you hold their feet to the fire on performance. That's very important.
Yeah. And I think it's again, one of those old adages, but you don't always, nothing's free, right? Well, nothing's good free. Like, put it that way. They're very rare that you get excellent advice or excellent service or an excellent product and had paid nothing for it. So you have to probably expect that you're going to pay a little something for this if you have a good quality investment advisor. But ideally, that's going to be, again, an investment that's going to pay off for you because they're going to be watching over you and making sure that your money is taken care of.
An investment advisor also is not only a person who can make you money, but communicates. The communication is probably about just as equal 50% to the investments that that person has for you. Because if you're not aware of how well you're doing, or if they don't share their performance, then again, if you're in the dark, how do you have any faith in that person?
Yeah.
So it's very important that not only the investments, but the communication be there as well for a good investment advisor.
Okay. So just to sort of start to put a bit of a bow on some of this stuff here, what type of information would you ask for a client, or what do you look for if someone comes to you and says, "Hey, I want to invest something in, yeah, I'm maxed out with my employer, but now I have some extra money I want to talk to you about."
Yes. Then what we do is as I mentioned earlier, we start to sit down and say, okay, let's say you have $100,000. What are your near-term goals for this money? Are you going to buy a new car? Are you going to remodel your house? Are you going to go buy a house down in another state? And if somebody comes to me and says, you know what, Frank, I don't need the money for the next 5 to 10 years. Then after that, so we kind of get like the initial background on what their plans are, their usage for the money, if you will. And if they tell me that it's just disposable money that they don't need right now, then we start to formulate. We talk about how much risk they want to take on with how much risk, meaning you want 10% in the stock market, 20, 30, or none at all. So then we start to formulate a risk profile. And then from that point on, we get it invested. And then we start to report to them on a quarterly basis. Again, that's that consumer communication. And believe me, when the market from 2008, which was our last recession, basically crash in the markets, to 2021, markets went basically straight up. So all the clients, even when I was trying to call them and talk to them, oh, we're good, you don't have to call me. They were watching the news. And they see, but when 2022 came about, we had an unprecedented drop in both the stock market and the fixed income market, which usually doesn't happen like that. Then that's when people got very nervous. So the more that you could talk to them on a regular basis, the more they'll be prepared for something like 2022 from the investment standpoint comes about. There again, it's not just initial meeting, getting their goals for the money or learning their risk tolerance. It's the constant contact with them as time goes on.
I can truly appreciate that. Even if you take it out of the investment world and put it into some other things, if you drop your car off at the mechanic and you say, hey, just do what it needs, and then you never hear from him for a day or two, you start to wonder, like, what's going on? Like, right. I don't understand. And you start to get nervous. You start to wonder. And in reality, it may be something as simple as they didn't get around to working on it yet. Right. And there's nothing happening. On the other hand, your car could be in pieces and there might have, so that communication back and forth is very reassuring, I think. That's for right. people. Even in bad times, the communication, the awareness that that something bad is happening too. Right. That you're not sitting there not paying attention. I think that means a lot to people.
It does. And, to be quite honest, Drew, we have the same investments that an investment advisor down the street has. What it comes down to, I'd say 95% of my clients is becoming part of their family, getting close to them so that they could trust you. And that's the big word, trust. Because if they trust you, then you could not only retain them as a client, but they'll end up giving you potentially more monies to invest. So becoming, again, a family member, if you will, and that's what I try to do with a lot of my clients, get very close, become friends, and become a family member that way. That's very important in this type of line of business.
Yeah. Well, this has been incredibly enlightening, and I really hope that a lot of people are sort of, expanded on their knowledge as I have been, because honestly, this has been very, very interesting to talk about. I'd love to have you. I'm sure there's probably more you could tell us, but
wow, too much probably. Drew.
Yeah,
I'll tell you more than you want to hear.
Yeah, but no, thank you very much for doing this. If you have questions or anything like that that you would maybe like to pose to Frank or us, obviously go to AmeriServ.com/bankchats. There's a form out there you can fill out. You can ask questions. You can give us some feedback about the show. Let us know what you think. Obviously, we always encourage you to subscribe or like to the podcast so that you can follow us and don't miss any episodes. Frank, thank you very, very much for your time.
You're welcome, Drew. Appreciate the opportunity.
This podcast focuses on having valuable conversations on various topics related to banking and financial health. The podcast is grounded in having open conversations with professionals and experts, with the goal of helping to take some of the mystery out of financial and related topics, as learning about financial products and services can help you make more informed financial decisions. Please keep in mind that the information contained within this podcast and any resources available for download from our website or other resources relating to bank chats is not intended and should not be understood or interpreted to be financial advice. The host, guests, and production staff of Bank Chats expressly recommend that you seek advice from a trusted financial professional before making financial decisions. The host of Bank Chats is not an attorney, accountant, or financial advisor, and the program is simply intended as one source of information. The podcast is not a substitute for a financial professional who is aware of the facts and circumstances of your individual situation. People can invest in many things. We invest in our families, in our hobbies and passions, and we invest money to provide for our future. But just as having a good teacher can better help you to learn a new language, having a qualified investment advisor who can work with you to help reach your financial goals is typically better than going it alone. No one can ever guarantee a positive result, but there are people who have the experience and knowledge to help make a stronger, educated guess when it comes to your 401k, IRA, or other investments. I want to thank Frank Lapinsky for joining us on the program today. You can find out more about Westchester Capital Advisors by visiting their website. The link is in the description. My thanks, as always, to Jeff McTavish for his editing and production skills. AmeriServ Presents Bank Chats is produced and distributed by AmeriServ Financial Incorporated. Music by Rattlesnake, Milo, and Andrea Kalitkin. Episodes can be found wherever fine podcasts are downloaded, or by visiting ameriserv.com/bankchats. For now, I'm Drew Thomas. So long. Westchester Capital Advisors Incorporated is a registered investment advisor and a wholly owned subsidiary of AmeriServ Financial Bank. Keep in mind that investing in securities involves a risk of loss that you should be prepared to bear. Over time, assets will fluctuate and be worth more or less than the initial invested amount. Depending on the investment type, differing risk levels will exist. Westchester Capital Advisors cannot offer any guarantees or promises that a client's financial goals and objectives will be met. Westchester Capital Advisors does not provide tax advice. Recommendations on specific investment vehicles are meant to be generic in nature. You should consult your personal financial advisor to discuss the right vehicle for you. There can be no assurance that advisory services will result in any particular result, tax, or legal consequence. Westchester Capital Advisors does not charge fees based on a share of capital gains on or capital appreciation of the funds of clients, but rather on the total assets under management. This fee increases as your account value increases. See Westchester Capital Advisors Form ADV disclosures to understand how fees are charged along with other important information about their services.